Okay, let's go ahead and get started. What I asked you guys to do was to kind of look through the first few chapters of the real estate finance book, and then also to kind of start looking at the videos that I posted on Dropbox with respect to the problems that have been posted there, and then also the video solutions that worked through the problems to kind of get yourself familiar with using the financial calculator and kind of understanding some of these concepts. So what I'm going to start with is effectively, one of those things that is posted is kind of a refresher on time value of money, and then from there it sort of skips into fixed rate mortgage questions and then into sort of adjustable rate mortgage questions. And so today's problems are going to be based off of effectively those that problem set that's posted in Dropbox. Okay? Justin?
Chapters 1, 2, and 8, right? That you wanted us to read, you said?
Yeah. So effectively read through, but in terms of the problems, you're focused on, once again, the handouts there.
Okay.
All right, so what we're going to do is we're going to start out and we'll kind of work through a number of these problems that, once again, kind of give you some additional experience in using the financial calculator. Videos of all these problems have already been posted on Dropbox and are there available for your use, okay? So effectively, all I'm going to be doing kind of this morning is kind of work through a couple of these and then just sort of take questions that hopefully, I know that a few of you have been sending me a couple of questions about some of the problems, and we'll kind of try to take those as we can and kind of work through some of those issues. So let's do this. Let's start out, if you go specifically to that set of handouts, to problem 4.1, okay?
Corey, do you have an extra copy of the handout?
No, it's all online, okay. All on the Dropbox. Okay.
What is the username and password for these things?
The username and password for the computers here. It's lowercase r, lowercase m, 32-423 is the username, and the password is uppercase A, lowercase s, lowercase k, lowercase e, lowercase w, at, lowercase b, lowercase c. Okay, so this first problem states that you've got a borrower that obtains a fully amortized fixed rate mortgage for $125,000. This is problem 4.1. And so we've got the mortgage of $125,000. That's going to be our present value. And the interest rate is 8%, and the term is for 30 years. Now, in this particular instance, the thing that they ask you is, what is the monthly payment? Now, 9 times out of 10, whenever we're dealing with mortgages, we're going to be dealing with monthly payments, monthly compounding. So whenever you start out, the very first thing that you want to do on virtually every single problem is to identify what that number of compounding periods is going to be, whether it's 1 payment per year or, in this case, 12 payments per year for monthly payments. All right? And typically, the other thing that you're going to want to make sure that you do is that you clear everything out in the calculator, so we hit the clear all key. And that just takes care of clearing out the memory registers out of the calculator from any sort of previous problems that may have been placed there. So once again, we've got our loan amount, we've got our interest rate, we've got our term, and once again, whenever you put in the 30 shift in, what's going to pop up in your display is 360, meaning 360 months, okay? And what it's actually doing, just so that you kind of have that in your head, is it's basically taking the 30 years, and by virtue of hitting the shift key, it is multiplying that 30 times the number of compounding periods, or 12 payments per year, and that's where it's coming up with the 360. All right? So the final step in actually solving for the payment is just as simply it's payment key. Okay? So once we do this, let's see what we get. You should get 917, 21 rounded. Okay? Now, one of the things that you should take note of is this negative number on the payment. What that is indicating to you from the calculator's perspective is that is considered to be a cash outflow, okay? Meaning that is technically money that you're writing a check for to the lender, okay? All of this other, from your perspective as the borrower, you're getting $125,000. You're paying 8% for 360 months or 30 years, but yet what you're actually paying out every single month from your perspective is the 917.21, okay? Any questions about that? Okay? The second part of that question is part B. It says, what is the balance of the loan at the end of the first year? Okay? Now, if you remember from last week, and also if you've gone through these problems as you were supposed to have done, you can use the calculator's amortization function, okay? Which allows you to look for any period of time what the total amount of interest, principal, but more specifically what we're searching for here, what is the ending balance of the loan at a specific point in time. So this is asking you, what is the loan balance at the end of the first year? Okay, so what we're going to do, following right along, you're going to put in 1, input 12, shift, amortize, equal, equal, equal. Now what this is doing from the calculator's perspective is saying, all right, I want to access the information for period or payment number 1 through period number 12. Now, keep in mind, once again, all the calculator is doing is just sort of accessing its own internal information about what took place during that period of time of period 1 through 12, or in essence, the first year of the mortgage. All right? And so you're accessing all that amortization information within the calculator. The first time that you hit the equal key, what you're going to get is the principal that has been paid during that first year. Well, that's not what we're searching for, but that's the information that you're going to receive is the principal that has been paid during that first 12 months or first year. You hit the equal key again, and you get $9,962.26, which is the interest that has been paid over the first year or the first 12 months. You hit the equal key again, and that's giving us what our loan balance is at the end of year 1, which in this case is $123,955.80 rounded. Okay? Now this format you're going to use over and over and over and over again. So it's something that you need to obviously commit to memory and understand what it is that you're actually putting in and what you're solving for. Now, one of the most common questions that people usually ask up front, does it matter what order that I put this information in? In other words, the loan amount, interest rate, and the term. No, you can actually put them in any order that you want, those 3 variables. Now, what does matter is what follows from there in terms of what it is you're solving for, and then ultimately, coming up with your balance. But we could have put those in, in any order, and it wouldn't have been an issue. Okay? Yep, Frank.
What's the logic of 1 input 12 What is that telling the calculator to
Okay,
do again?
what it's doing is it's saying to the calculator, give me the information about this particular loan for period number 1 through period 12, which is the first 12 months of the loan.
Okay.
Now, if I wanted, just hypothetically, what if I wanted year 2? What would I put in?
2 input.
13, input 24. If I wanted year 3, it would be 25, input 36. If I wanted year 4, it would be 37, input 48. If I wanted year 5, it would be 49, input 60, and so forth, so on.
And
Okay?
you use those figures because it's in a 12-month period.
Correct.
If it was in a different month period, or
Well,
if it was in the one payment per year.
Yeah, if it's one payment per year, then it's just, 1, 2, 3, 4, but most mortgages are going to be set up obviously on a monthly basis. So you do need to become comfortable with, this whole thing of knowing that for year 1 is going to be months 1 through 12, year 2, 13 to 24, year 3, 25 to 36, year 4, 37 to 48, year 5, 49 to 60. And no one is inherently going to tell you that. In other words, if I just were to simply say on a test, what is the total amount of interest paid during year 3, you've got to know, all right, that's months 25 to 36.
25 input 36.
Right. Now, the thing that you also want to start to getting into your mind is, why is it not like 12 to 24 or 24 to 36? Because if 12 is December, if you will, of that first year, 13 is January,
Right.
if you will, okay? So if you were to have just started with 12, it would have given you effectively a full year plus 1 month. Does that make sense?
Yeah.
Now, be very careful about that. That's probably one of the simplest rookie mistakes is to effectively, not making sure that you are putting in the proper beginning term for the number of months, okay? Make sense?
Yeah.
Okay. Now, all right, let's move forward. Okay, let's take a look at question 4.2. Now, I'm not going to work, obviously all this is going to work a couple of them. All of these that I'm working right now are already worked for you on Dropbox, okay? They're already videos of me basically working them. So, in essence, I'm kind of repeating what's already there, but I just want to take this time to kind of work through a couple of them to kind of make sure that you're zoning in on kind of some of the important things to sort of keep track of. Okay, so the second one, we've got a 30-year mortgage that was made 5 years ago for $80,000 at a 10% interest rate. After winning the lottery, the borrower would like to prepay the mortgage balance by $8,000. Okay, so the first thing that we're going to do is we're going to go ahead and get everything set up as 12 payments per year. Go ahead and clear everything out. And we start out with the original loan amount of the $80,000 at 10%, and it was a 30-year mortgage. And we start off with calculating what is the monthly payment. Okay. We should get 702.06 rounded. Okay. Now, what it's actually asking us to do, however, is it's saying that this loan was made 5 years ago, and the borrower wants to prepay the mortgage balance by $8,000. So the first thing we're going to need to do is we need to find out what the current balance is after 5 years. Okay, so Once again, employing the logic that we just employed from the previous problem to find a loan balance at the end of a certain period of time, what are we going to do? We're going to have something, input something, shift, amortize, equal, equal, equal. So we're going to be these two amounts.
One input 60.
One input 60, okay? Because we're wanting to access the information over the entire 60 months from period 1 through period 60, okay? And double check that. I'm wrong. Okay. 2740. 54 is going to be the principal, which we don't need at the moment. The interest, 39,382. What? Hold on, double check. I think I may have hit something accidentally here. Yeah, no, that's right. 39,382 interest and 77,259.46 is going to be the balance. Now, once again, if you remember from our discussions, 2 weeks ago, the sort of disturbing part of this is we're 5 years into this loan. 5 years. We've only paid down $2,700 of that loan. The overwhelming majority of our payments have gone toward just interest, okay? Leaving us with the balance after 5 years of still $77,000, okay? Everybody with me on that? Okay, yes it is, but that's the way it works. Okay, now, what we are asked to do in this particular problem is we have a borrower that has received some lottery winnings of $8,000, wants to pay down the balance of this by $8,000, okay? So the first thing we're probably going to do is subtract $8,000 from that balance, and that's going to give us $69,259.46 as the new balance. All right. So the problem states, assuming that the loan maturity is shortened, what is the new loan maturity? Meaning that the payment actually stays the same, okay? So what they're saying is, in this particular instance, we have made 5 years worth of payments. Normally, that would mean for a 30-year mortgage, we would still have how many years to go? 25. What they're asking us, however, is because we have made this extra payment of $8,000, what does that do to us with regard to potentially shortening our loan term, okay, by effectively paying down some of that principal early? And this is obviously one of the things that you can do with, whether it's a residential mortgage or with a commercial mortgage, is most of the time, I mean, once again, there are always restrictions, but you can pay down the principal balance, thereby shortening the loan term, okay? So what you're going to do is you're going to put this amount, you're effectively going to sort of think about this as a new problem to a certain extent. This is going to be your new loan amount. You're going to keep your payment of the $702.06, You're going to keep your interest rate of 10%, but what you're going to be doing is you're going to be solving for what is the new term. Okay, does that make sense?
Yeah.
Here's the way to, now, before we do this is, you know, before you get yourself all worked up and concerned about this sort of thing, there's literally only 4 or 5 variables that we're constantly sort of shifting and changing, and it's like if you change one, it changes the others. Okay? And that's basically what we're doing here, is you're sort of replacing one with another and then seeing what the impact is.
Right.
Does that make sense? Okay, so.
So you would just make that the PV and then.
Correct. So we can actually flow down right from here, put in 69,259.46 as our new loan amount. And so we're not changing our payment. We're not changing our interest rate. We have already changed our present value.
Right.
So all that's left is we want to find out what is effectively the new term based upon this, okay? So solve for n. Now, and divided by 12, oops, right. Is now 17.33 years is the remaining term, okay? Now, let me just see if you're paying attention and you're actually following the logic here. Is it 17.33 years overall, or is it 17.33 years plus 5 years?
Plus 5.
It's 17.33 plus the 5, because this is making the assumption that we've already, once again, paid down the balance
Right.
some, obviously, to get this principal reduction here. So we're picking up from that point along with this 8,000. So we have already paid 5 years worth of payments. We're going to have to pay another 17 years worth of payments. But just if we were to just kind of look at this, so 17.33 plus 5 means that overall, what we started with, a 30-year loan, we're now down to a 22.3-year loan. Okay, this is the whole thing, and you probably have heard this on residential mortgages, that if you effectively make an extra payment or two every year, if you have a 30-year mortgage and you make an extra payment or two every year of just principal, you can typically reduce your term down to maybe 15 to 20 years. And that is true, okay? Because so much of those initial payments are really just going totally toward interest. So in order to pay that balance down, but unfortunately most people don't do that. Most people, once again, if they get into a home, you know, they typically make the mistake of getting the most expensive home that they can afford based upon the income that they currently have, and as a result they end up getting overextended, and the next thing you know, they're not able to almost even keep up with the current payments, let alone trying to make additional payments to pay down effectively the balance. Now, the strategy that some people, employ that maybe helps them to get past that a little bit is, using their income tax refund that they would get from the mortgage interest, deduction off of their federal income tax, and then use that refund check to make those extra principal payments. So just something else to, once again, it was not a residential real estate class, but just kind of some things to sort of keep into perspective. Okay, any questions about this? Any questions about the logic or thoughts? Yep.
So can you, on this problem here, could you go a step further and say if I made an additional payment at the end of each year on this, how many years I have left?
You can. It's a little bit. That would involve us. Well, what we could do, we could approach it a couple of different ways, but probably the easiest in that instance is probably going to be using Excel. because it's just gonna be, for that specific sort of instance of making that additional sort of payment, you're gonna have to apply it each year,
Okay,
and it's just gonna be very tedious,
I got you.
sort of. We can do it, but it's just gonna be real tedious. But in Excel, we can just pop it in as an extra payment and super simple. Okay? Any other questions or thoughts? Okay? Second part of this problem, assuming that he can reduce his monthly mortgage payments, what is the new mortgage payment, keeping the maturity the same? So what they're asking now is, all right, instead of reducing the term, okay, he wants to actually go ahead and continue to make payments, you know, for the remaining 25 years, but he wants to actually just instead reduce the actual payment amount from the 702 to something lower. Does that make sense? So in other words, we kind of forget about, okay, once again, sort of think about it as a completely separate problem. You sort of forget about all this work that we did here of effectively calculating what the new term is going to be, and instead focus on just solving for what would be the new payment amount. Okay, does that make sense?
Yeah.
All right, so what you're going to do, if you want to not have to kind of re-enter a bunch of stuff, you can just replace a couple of key variables and probably get precisely what we want. So those key variables, we would start off with N is going to be 25 years times 12, or 300 is going to be our term. Or we could put it in as 25 shift in, okay? And then once you've done that, you should be able to sort of follow through and then just simply solve for the new payment.
629.
Okay, I'm just going to trust you. What is it, 629?
629.36.
Yeah.
Okay. Does that make sense to everybody?
Yeah.
Yep.
Okay. Any questions on that? Okay. All right.
Just at that point, instead of including the original 5 years, you're going as if it was a new loan with.
Effectively, that's what you're saying. You're sort of, in one sense, it's kind of like a refinancing, which we're going to get into as well. But in a lot of these instances, what you do is to keep it really clean, you could effectively start over as if it were a brand new problem. In a lot of cases, we do just kind of follow on, replace one variable and that sort of thing to keep us from having to re-enter a lot of the information, you know, completely over again. But you know, in most instances, yeah, you would sort of look at it as if it were effectively a new loan for the remaining 25 years. Okay? Make sense?
But a lender wouldn't typically allow you to like change your monthly payment, right? Because you reduced it. You'll have to go in for like a sort of like a refinance to do that, right?
Most of the time, no, but yet there are those instances of where you could. I mean, there are no, in my mind, there are no absolutes. It's kind of like there are, the overwhelming majority of cases, no, you would not be able to do that. But are there circumstances where you would be allowed to do that? Absolutely. Okay. And it totally depends on how the loan documents are structured up front as to what they will allow you to do. Most loans will allow you to prepay, you know, bits and pieces along the way to bring down your mortgage balance. That's pretty much a given. With the exception of a lot of CMBS loans that we had talked about, you know, a couple of weeks ago, where they tend to want to lock everything in. It's a fixed deal for that whatever period of time, 5 years, and you really don't have a choice at all. It's just you're going to make that payment. You can't pay it off early. You can't pay it down. You're sort of stuck with it.
And that's typically because it's institutional.
Correct. More of an institutional kind of loan. Okay. All right. Moving forward. All right. 40 at uta.edu, password Jaguar. Okay. All right, problem 4.3,
Which file is it under?
sample problems.
So,
It's a PDF.
Okay.
Okay. Okay, problem 4.3 is that you've got a lender offering a fixed rate mortgage under the following terms of $90,000 as the loan amount, 7.25 as the interest rate for 30 years. And the lender is going to charge you 2 discount points to make the loan. What's the APR, or annual percentage rate, on the loan? Okay, so once again, we start out as if it is a monthly loan, 12 payments per year. Put in the basic loan information. Start off by solving for what is the monthly payment. We get 613, 95, 96. Okay, so here's the loan, and what we're being told is this particular lender is going to charge us 2 discount points, also known as loan origination fees. Okay, and as we talked about a couple of weeks ago, those are the fees that are charged by the lender, typically, you know, to compensate them for the actual origination of the loan, to kind of take care of their internal paperwork and people and that sort of thing to originate the loan. And those fees are what a lot of lenders rely upon to actually earn a profit off of these loans. They're making more money in many cases off the origination fees than they may be making off of the long-term interest on the loans, okay, in terms of the ability to effectively churn these loans by virtue of make the loan, as soon as they make it, sell it off into the secondary mortgage markets, recapitalize themselves as an institution, and then continue making more and more loans. Once again, then sell them off, start the process all over again. Okay, make sense? Okay, so in this case, they're being charged 2 discount points. Now the way you calculate the discount points is, once again, for 2 points, it's 2% of the loan amount. Okay, 2%. So 2% times 90,000 is going to be $1,800 in loan origination fees or discount points. Okay. Everybody with me on that?
Yeah.
Yep.
Has a issue with a calculator.
Okay.
It's coming up short.
It's coming up short.
20, yeah, we get, minus 613.96.
Yep.
Minus like 597. I don't know, I got that.
Okay, it may be, once again, okay, make sure you're clearing everything out. Do the shift clear all, and then put everything back in just as is. Try it again. Well, actually, it may be because you're in, is the word begin in your
Yes.
Okay, hit the shift key, and we're gonna talk about this later. Hit the shift key and hit the end, begin end key up in the kind of upper right hand corner. You see that?
Oh, that, I was doing practice, yeah.
Okay, hit the, and once you do that, then that will shift back to the end mode, which we'll talk about later.
Okay.
Okay, and now if you put it in again, it'll work. Okay. All right, so we got $1,800 in discount points. Now, if you remember from our discussion, you know, a couple of weeks ago, the idea of discount points and the way that they work is you go into the lender, they are effectively giving you a check for $90,000. In return, you are giving them a check for $1,800. Okay? So the net result is you're really not getting, or you're really not borrowing the full $90,000 in your eyes as the borrower. From the lender's perspective, you know, they are effectively dispersing 90,000, and they are going to get paid back that full 90,000 by virtue of the payments that they receive from you, plus they get the $1,800 in discount points. And that's where that is what causes effectively their rate of return or the APR on the loan to go up. And so what we're going to do is show you how to do that. Yep.
Why are they called discount points then?
Okay. Because in some instances, historically, lenders have used them to allow you to buy down the interest rate on a loan, and they will effectively say, we will charge you these extra upfront prepaid interest in the form of discount points, and in exchange for that, we'll maybe lower your stated interest rate ever so slightly because of that. But yet the reality of it is they're loan origination fees. Okay? Okay. So what we need to do subtract out the 1,800 from the 90,000. We get 88,200. So that, in essence, is going to be our new loan amount or present value. And then we're simply going to solve for what is our APR or effective cost of borrowing. And so our interest rate, effectively, our APR, is going to be 7.45%. Okay, everybody good? Yes, no, possibly could be?
Yes.
Okay. All right. So any questions on that? Are we good? Now, Tyler, in your question, it's kind of interesting as well. The whole notion of points itself and kind of where does that word come from?
Yeah.
Okay, this is kind of it's not that interesting, but it's kind of, whenever you typically look at an interest rate and you quote an interest rate and we sort of say, okay, our interest rate on this loan is 7.25, okay? Basically, what they're doing is they're trying to distinguish between the interest rate on the loan and these loan origination fees, instead of, because they could say your interest rate on the loan is 7.25 plus an additional 2% in loan origination fees, but they're afraid that that somehow is going to sound like, well, then your interest rate is like 9.25. But that's not what it is. So that's why they tend to use slightly different terminology of just simply saying, okay, it is effectively you're adding 2 points or 2%, which is nothing more than 2% of the loan amount. Make sense?
Yeah.
So here you're paying down, I guess the interest rate that they would have quoted you would have been like 7.5. You pay the 1,800, you get it down to 7.25. Because really you're paying down for a higher interest rate.
Oh, in this particular instance, don't look at it as being you're paying down the interest, because you're not. That's going to be another example later.
Okay.
Here, they use this terminology interchangeably, which gets really confusing. That's why I tend to sort of stick with loan origination fees.
Gotcha.
Because to me, that's really what it is. They can call it
Okay.
discount points, they can just call it points, they can call it, some other fee for transacting the loan, come up with all, these sorts of things. The buy down on the interest rate, we'll talk about later.
It should be, it's the opposite. It's not a discount. It's a premium.
And as I
Or
said,
I don't know what you call it.
we will
Opposite discount.
definitely talk about it later.
Non-discount loans. I mean, points.
Because what can also happen is you'll have a lender, or not a lender, you'll actually have a developer that will offer to buy down your interest rate as well. And so to help you basically afford a more expensive home or a more expensive property, to also help keep the price point of that property higher than it would be otherwise, because you're effectively getting below market financing. That's, once again, another topic for later, okay? Okay. Let's move forward here. Okay. Now, as I mentioned, for those of you that sort of wandered in a little bit late, the problems that I'm working are from the Dropbox account, specifically some of the sample problems. What I had asked you guys to do a couple of weeks ago was to start looking at those sample problems, to look through the videos, and the videos go through all of these sample problems, work through all these sample problems, and hopefully you have begun to do that, because it's the practice that you get from sort of working through these things that is going to help you sort of nail it into your head. If you just, try to cold turkey, try to work through some of these without having had that practice, it's going to be a real challenge, if not almost impossible. So what I want to do at this point, now that I've worked through just a couple of these things and kind of explained, some concepts for those of you that maybe, a couple of things maybe been stuck on. As you worked through the problems, as you looked at those problems, as you looked at the videos for the sample problems, is there anything that sort of popped up that you're still struggling with? Yep.
I know me personally. Okay, sometimes when you do the number, like the shift for the N,
Yep.
and then sometimes you just do the number and then
Yep.
the N.
Yep.
That kind of confuses me.
Okay.
Sometimes.
So here's the situation. If you have annual payments, you're set on one payment per year. And so you're always simply going to put in what the term is, and you can put in, like for example, if we have a 5-year loan, we can put in 5 shift in, or we can simply put in 5 in, because the number of compounding periods is only one time per year. So in other words, what it's doing is it's still coming, if you put in the shift here, it's still going to say 5 times 1 is still 5.
Mm-hmm.
Whereas if we put it as 5 in, well, it's not doing anything to transform that, but it's still staying 5 as well. But that's only with the annual compounding. With the monthly compounding, which is the majority of the time what we're it's 12 payments per year. And so for a 5-year loan, if we put in 5 shift in, that is going to be 60 months, okay? So we have the choice of whether we put it in as 5 shift in or 60 in, okay? And that's just a choice that we make as to which one we want to do, and we can do either. The calculator doesn't care, in this instance, of whether we put it in as 5 shift in or 60 in. The 5 shift in, by putting in that shift, it is simply saying 5 times 12 equals the 60.
Right.
By not putting it in, then it doesn't do that math. It just simply says it's 60 periods, or 60 months in this case.
Because when I was like, it seems similar, but then when I tried to just do it either way, I got different answers. So I was like,
The only time that you would get you would get a different answer in the sense that if you just put in 5 in here,
right,
that with monthly compounding, what that's saying 5 months.
right. It's not doing it times 12.
Right.
Yeah, I got it now. Thanks.
The easiest way for me on this one is always do shift in,
Mm-hmm.
even if you have one payment per year, because it's going to give you the right answer. You just
Okay, so
always do shift in, and you never have to think
All
about
right,
it.
because I'm like,
Yeah, the
Sometimes when I was watching
only time
it-
that can be a problem though is if you have a weird number of months.
Okay.
Like for example, what if I told you you've got a 62-month loan, which would be 5 years and 2 months.
You
Okay.
gotta put it in.
gotcha.
You have to do it in months.
Yeah.
Just do in.
Right.
All right.
But 99% of our loans are going to
It's the
be,
shift.
it's going to be the situation of where it's going to be an equal number. Well, in other words, it's going to be like 5 years, or it's going to be 10 years, or 15 years. Very seldom are we going to have. it's a 183-month loan or
Right.
whatever.
Okay, thank you.
But we can have that,
Yeah.
okay?
Right.
You need to know how to do it.
Mark?
What if you're targeting like one particular month, not a duration, let's say like you wanna go straight to one
Yeah,
month,
okay, if you wanna go to 1 month, then the business is, like, for example, if you wanna go to month 17, you could just do 17, input, 17,
Okay.
shift, amortize, equal, 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 and that will give you just the information for that month of the principal, interest, and the balance at the end of that 17th month. Okay, make sense?
Makes sense?
Perfect, good question. Brian?
I was confused on the language used in A20. This is where the deposits are every 6 months.
I'm sorry? Yep.
I did it outside.
Okay. A20?
Yeah.
Okay.
So
Yeah,
they're
oh, and just to preface, language is a really important thing, and sometimes some of these problems, you know, I try to be pretty explicit in what I'm asking for. In this particular, you know, case, there's sometimes the verbiage can be a little bit tricky, you know, not necessarily intentionally, but sometimes it's not as clear, or it seems to kind of be asking for something that it's really not. And what you usually should do, this just, you know, whenever I look at virtually every problem, I tend to sort of, the first question I almost always ask, is this going to be annual compounding? Is this going to be monthly compounding? Is it going to be quarterly, semi-annual, daily, you know, whatever? And that's the first thing I usually start with. Now, in certain instances, now you look at this one, and you know, and you see annual interest, but yet at the same time, it's talking about making deposits at the end of each 6 months.
Yeah.
Well, because those deposits are, the only way the calculator can really accept those deposits in a fraction of a year is to be able to say, well, those are occurring every 6 months, or the number of compounding periods would be twice a year.
Okay.
And so,
You put 2 payments per year.
2 payments per year. And so, as an example, and this is another good point to sort of generically, then we'll follow on with a bigger problem. Annual compounding. Now, 99% of the problems that we typically are going to be dealing with are going to be annual or monthly. Let me just sort of preface that, okay? In all of real estate. Very, very seldom do we do the other weird compounding periods, but yet you still need to be aware of them just from the standpoint that they do exist, just really rare that you're going to see them. But for annual, that's obviously 1 payment per year. If we sort of stair step it, semi-annual,
And
be twice a year, quarterly, 4 times a year, monthly, 12 times a year, daily. Well, actually, you could do bi-weekly or bi-monthly. You could do that. Very seldom you're going to see that, but let's say bi-monthly, twice a month, which would be 24. You could also do effectively every other week, which would be 26. This is another thing to point out. I'm going to come back to that just real quickly here in a second. We can do weekly, 52. We can do daily, which the convention can be, some folks will do 360, some banks will do 365, and they'll typically state that in the loan documents as to whether they're making the assumption it's a year based on 360 days or based on 365 days, okay? Now, and we can also do, for the purposes of our calculator, what is continuous compounding, which would be like 999 compounding periods per year. Now,
Wouldn't bi-monthly be 6, because it's every 2 months?
well, let's just say twice a month then. Okay, so the difference here, and this is one of the things that a lot of people will sort of get hung up on, is there a difference between twice a month and every other week? Because for those people that I don't want to get too deep into this, but it's interesting because internationally, like for example in places like New Zealand and Australia and sometimes in the UK, whenever they quote rental rates for certain types of properties, they will quote it on a weekly basis, and automatically our assumption is to do what? Multiply the weekly times 4 to give us a monthly. Well, if you do that, that's only 48 weeks out of the course of the year, correct? In other words, do the math, okay? Once again, 4 weeks times 12 would be 48 weeks in the year, leaving an extra 4 weeks.
That's 12 months that have-
So in essence, there's a 13th month in one sense from the standpoint of, and so here's my point. Okay, like if I quoted you, let's just say like a rental rate, and I said, all right, I'm gonna charge you $1,000 a month for an apartment, versus I'm gonna charge you $250 a week. Most of you would just instantly think, that's the same thing. But it's not. Because $250 a week is actually more rent.
Yeah.
It's a full extra month of rent, it's an extra $1,000 a year of rent.
Yeah.
You follow me on that? Okay? And a lot of this is a carryover historically. This is kind of an interesting thing, at least to me it is, just from the standpoint of kind of a carryover of where people used to get paid weekly. And so therefore, a lot of the rents would be set up on a weekly basis, and then they would make their rental payments at the end of the week whenever they got paid. And it's only, you know, we've kind of gotten into this monthly thing that ultimately it sort of got converted that way. But anyway, all right, but these are the different compounding periods that effectively that you would see. Now, as I said, 9 times out of 10, you know, it's going to be annual or it's going to be monthly for our purposes, but every so often, yeah, there's going to be something like a quarterly or a semi-annual or whatever it might be. Now, so this particular problem, question A20 specifically, you've got a deposit that you're planning to make at the end of each 6 months for the next 10 years, and you can earn 6% interest rate. Okay, so what this is, this effectively is an annuity payment that you are depositing every 6 months. So what we're going to do, 2 payments per year, and we said it's $4,000. Now what I would tend to do is make that $4,000 a negative number, because we are depositing that amount. In other words, that is a cash outflow from our perspective as the person depositing these funds, and it is over the next 10 years, so 10 shift in, and so what this is going to do is this is going to say 10 times 2, or 20 periods, okay? Still 10 years, but over 20 periods because it's happening twice a year, okay? And interest rate is 6%. And we are asked what is the balance at the end of all that, so we're going to be solving for future value. Okay, so let's do that real quick. Okay, what do you get? 107? 481, yeah, 49.50. Okay? Make sense?
Basically, that's just overthinking the annual part of that.
Yep. Sometimes, you know, and that's what I'm saying, you know, it's, they probably should have just simply said, your interest rate is 6%. Instead of saying it was a 6% annual rate, they should have just simply said 6% interest rate. But the problem with that is, having just said what I just said, is you could have some folks saying, well, but that interest rate, if they don't state it, then is that every 6 months?
Right.
Which it could be. Very rare would it be that way. So, but hopefully you understand though what, yeah, okay. All right, now, moving forward.
Wait, what about the second part of that question?
Okay, hold on. Second part, if the deposits were structured as an annuity due, good save. If they were structured as an annuity due, what is the balance at the end of 10 years? Okay, this gets to specifically the issue of whether the payments are made at the beginning of the year or the beginning of the period or at the end of the period. Now, and this is, we'll go ahead and work it real quick. I'll just sort of show you how you get the answer, but I want to explain it because this is super important for real estate to understand this. So all you have to do to solve for this is to hit the shift key, the begin end key, which is upper right hand corner of the calculator that's underneath the margin key, MAR. Okay, it says begin / end. Okay, you hit that key, we resolve for future value, and now you get 110,705.94. But before we leave this, just so that you don't get screwed up in a future problem, because this is the problem Frederick had in the back, was on the begin end mode. Go ahead and shift it over back to the end mode. In other words, in your display, what you should have seen whenever you hit that first shift begin, in your display it will have BEG, BEG, right underneath the numbers there. And that is simply telling you it is in begin mode, okay? And I'm about to explain, so hopefully all the mysteries about that will go away. But what is happening here in this particular problem is that these payments of $4,000, where they were, if we sort of draw a timeline here for an instance, so here is, let's say, I'm trying to think the best way to label this is least confusing. So this is say 6 months. Well, no, that's probably not. Half a year. Let's just do that. Half a year, 1 year, and then year and a half, 1.5, 2 years. Okay. So normally, under this first instance, under end mode, what is occurring is you are making your first deposit here of $4,000. Your next one here of $4,000. Your next one there. Your next one there. And so forth, so on, for up to the full 10 years. Okay? The timing of the payments. The first one doesn't occur until the end of that first 6 months or half year. Does that make sense? Whenever you shift it to begin mode or annuity due, what is happening is this first payment and all of the other payments are being shifted up to the beginning of that period, so that you're making your first deposit immediately at time period 0. Okay? Does that make sense? Now, here is where this has direct application to real estate. Whenever you make a monthly mortgage payment to your lender, or you make a rental payment to your landlord, you typically make that payment at the beginning of the month.
Yeah.
Yes?
Yeah.
Okay, Tyler, you have a question?
Yeah, so the key word there is that if it's structured as an annuity, that means that it's in the beginning of the month.
If it's an annuity due, keyword being annuity due.
Okay.
The due part means it's due and payable immediately at the beginning of that month or beginning of that period or beginning of the year.
Okay.
Because you can still have an annuity due at the beginning of the year, which would mean, that, in other words, you make your payment at the beginning January, as opposed to normally you assume it's basically December. Now, this is the part that kind of begins to screw with your head a little bit, so just follow through with me just for a second, and I think it'll all become super clear, okay? You normally make, as I said, a mortgage payment or a rental payment at the beginning of the year, beginning of the period, correct? Everybody agree with me on that? Yes?
Advance.
If that isn't indeed the case, then you would think we would be using the begin mode always. We would always be treating everything as effectively an annuity due. Now, the reason why we don't is this. For accounting purposes, you make the assumption that the deposits are made, while they are being made at the beginning of the month, you're not realizing them for accounting purposes until the end of that month or end of that period, whenever all the bills have been paid and reconciled, and then at that point you are able to effectively recognize that income and that cash flow. Does that make sense? Okay. But for the purpose of, let's say, a tenant paying rent, from their perspective, it is cash flow out of their pocket at the beginning of the month or beginning of the year. So you could, if you're looking at it from their perspective, you could be looking at everything shifted one period. But for matter of standard, normal convention, we make the assumption that virtually all of the payments occur at the end of the period, end of the year, predominantly for accounting purposes. Okay, Dustin.
So, I guess if you're shifting it to the beginning, then you're dropping
You're dropping the end payment, the one.
Yeah, because if you add 4,000 to the 107,
Yeah, what's happening here is that in the first instance,
it's the same number of,
it's the same dollar amount.
it's the same number that you're depositing. It's just being shifted.
It's just being shifted one period. So in other words, in the first instance, your last $4,000 payment would have occurred here at the end of that 10th year. Okay? Whereas under the annuity due, your last $4,000 payment actually occurs now one period prior to that at 9.5 years. Does that make sense?
Yeah.
Because everything has been shifted back, in this case, 6 months.
But in that understanding, why is the future value?
Because because this has been received, or in other words, has been deposited earlier, so you're earning interest off of that $4,000 for that entire 10-year period. So what the difference between these two, what that represents is the interest that you have accumulated off of getting that $4,000 earlier, or depositing it earlier.
Better to get it early than late.
Okay?
Makes sense.
So if you did it 10 years and 1 month, you would be looking at the 10th payment on the beginning. Or the 10-year payment on the beginning.
Okay, one more time.
So if you did 10 years and 1 month,
Yes.
you're going to be recognized.
As a loan amount, you mean? Or as you put it in that way?
Yeah, just here, because then you would be counting the 10th. There would be an extra payment that you'd be recognizing in the.
So in other words, you're saying you would have had 61 payments, or not 61. I'm sorry. You would have had 21 payments. Is that what you're saying?
Yeah.
Instead of 20 payments.
No, you still have your 20 payments.
Okay.
But then it would be 10 years and a month.
But if you go 1 more month out, you're recognizing on the beginning mode the payment that you made in year 10.
No, because you would have not had a payment occurring in year 10 if you had gone 1 month out. You would have simply.
Just would have got.
You'd have one more month of interest that you would have collected, but another payment would have not have occurred because you only were scheduled to make a total of 20 payments.
All right.
Now, if they said that you continue to make payments beyond the 10-year term, then yes.
Okay.
I just wanted to clear up that Whenever the term compounding is used, it's referring to a payment being charged.
It's typically, it's what it's referring to is, from our purposes, are the number of compounding periods or the number of periods that we need to set the calculator up for the purposes of saying how often is the interest effectively compounded. Is it compounded monthly? Is it compounded annually, quarterly?
But when you say that, it's paid monthly, paid annually.
It is calculated on a monthly basis in the sense that you are effectively getting interest accumulated or paid in each one of those segmented time periods. So in other words, to say that the loan is a monthly loan, it is monthly compounding, meaning the interest is accumulated and calculated on a monthly basis. Whereas if it's an annual loan, then it is accumulated and paid on an annual basis. Now this is also one of the things that we're just sort of talking about, that from a practical perspective, that if you did an annual loan where you had annual payments, we're going to do the calculations as if the payment is, and that's what we're talking about, is received or effectively recorded from accounting purposes at the end of the year, even though you may have actually made the payment at the beginning of the year. Okay, as the tenant. That's what I'm saying. That's one of the things you've just got to reconcile that in your head as to what's occurring over that time period. It doesn't really get realized as income until the end of the period, just for accounting purposes. Okay, moving forward. Okay, other just sort of general sort of questions about the problems.
You mind looking at 823?
Sure. Okay. In this one, this is on an annual basis. So one payment per year. And so we've got a situation of that she is going to receive an investment that will pay her $5,000. So it's money she's going to receive. Therefore, that is a positive cash flow to her for $5,000 at the end of the year for the next 10 years. So 10 years is going to be our term. We can put it in either as 10 shift in or 10 in because it is annual compounding. All right. She requires a 14% rate of return. And what is the maximum that she can pay today for the investment to earn that required return?
Present value?
So it's just going to be present value. Okay. Once again, make sure you set yourself back to one payment per year. Okay, so she could afford to spend $26,080.58. Okay? Make sense?
Yeah.
All right. Now, just for a moment, let's kind of refocus and kind of rethink about this, you know, from a kind of the kind of problem that in practice that you would want to sort of solve with regard to a property that you're about to invest in. You know, this is the same sort of thing that what you're doing here is, you know, where would be a direct application of this in kind of a commercial real estate transaction? You could look at this as, this is a lease payment that you are receiving from a tenant for a 10-year term, and you're discounting it and you're sort of saying, I am demanding or wanting a 14% return on my capital. What is the present value of that lease to me as the property owner? Does that make sense? Okay. So, you know, all of these, while the wording may be based upon mortgage loans and that sort of thing, you can twist them and turn them into virtually any kind of application that may be of use to you. Well, where would you maybe want to know what the present value of a lease is? Well, obviously, if you're doing a retail center, All right? Why would you want to know the present value of the lease?
I think very simply, you know your money, you know what you're receiving now versus later.
Okay, but also you might, depending on what you're doing with the space, but you might want to, if you're doing a tenant finish out loan.
Well, exactly that. I actually, example, we have to give a tenant $100,000 for impact fees in a center in Orlando. We had to increase the rent incrementally to make up that $100,000. So that's exactly the case.
Yeah, so in some instances, you know, this whole business of saying, okay, well, if this is the, you know, the total amount of their lease payment and this is the present value of all of that, then we might have to, you know, that would be one application. Another, you know, as I said, would be that you're giving them a certain dollar amount for tenant finish out, and you're going to the lender and sort of saying, okay, well, this is the present value of the lease. We want to borrow a certain percentage of this to allow us to do the finish out or to pass the money on to the tenant to do the finish out, you know. But the point being is you need, you know, the lender's going to want to know how much is that lease worth, okay, in order to lend on it. Does that make sense?
Yeah.
Okay. Justin, question? You look like you've got a question.
Yeah, I just don't, for the logic on this, what you're solving for, I mean, okay, so if it is a lease, and they're gonna pay $5,000 a year, that's $60,000 a year, right?
Correct.
$5,000, that's $5,000 a year.
5,000
Okay.
times
Not a
10,
month.
so, yeah, 5,000 times 10 would be basically $50,000.
Okay. So, I mean, if the tenant came to you and said, what if I just pay the entire 5 years up front, what discount?
That would be awesome. Because they're, you know, because what this is doing, this is implying you've got a cost of capital or you've got a rate of return that you want to achieve, and what, in one sense, you could be saying is, if the tenant came up to you and said, I will give you $26,000 today, or I'll give you $50,000 over the next 10 years, that theoretically, at least based upon your required rate of return and reinvestment rate, you might be willing to accept that $26,000 as full and complete payment. In other words, discounted rent, because you're prepaying it all early.
All right.
And this happened.
Get a 14% return somewhere else.
Yeah, but I mean, you know, 14%
Right.
not realistic, but yeah, you might get obviously a 5% rate of return, which would be, you know, a bit more realistic. But this actually happens, you know, and historically, if you think back to like the late 90s, what was happening in the late 90s? We had the whole .com sort of boom and bust, the original boom and bust on the .com thing, for those of you that were alive and living in the late 90s, okay?
Barely.
But we had the whole boom and bust of the .com. Well, so you had the emergence of all of these high-tech firms that were all being, you know, started with all this venture capital that they were receiving, okay, and had gotten all this money up front, and they were going to lease space, and the property owners were basically saying, you're not really a credit tenant. You have no operating history whatsoever. So why are we going to effectively lease all this office space to you and potentially do all this finish out for you in this office space? We're just not going to do it. So what the property owners chose to do, for the most part, was to say, all right, you've got all this money now from your, effectively, your initial public offering or whatever you've done on to get your cash up front. We want you to prepay your rent for the next 5 years. And it was extremely common, you know, for these guys to prepay their rent in these complexes. And the property owners did some really, it happened all the time in Dallas. I mean, it was fascinating on the whole telecom corridor north of Dallas. It's happened, and so what you would have is a situation of where this rent had been prepaid for that 5-year period, and then the tenant blew up in the sense of ceased to exist after maybe 6 months or a year. The space still was basically already paid for, effectively, for that remaining, you know, 4 or 5 years, but the restriction was that if the property owner released it, they would forego that effectively prepaid rent. And so what many of the property owners did was they actually let the property sit there physically vacant, physically empty, so that they would not have to effectively pay back the original dollar amount. And so you had these weird phantom vacancies occurring in the office market there that you know, were totally distorting what was really happening, because it looked like you really didn't have any space available, which you in one sense really didn't, but yet physically you did. Does that make sense? And so, but the point as it relates to this problem is that in many instances they would have given them a discount on the rent, you know, saying, okay, you prepay us 5 years of rent up front and we'll knock off, you know, whatever, 10, 15, 20% over the entire lease term as a sort of trade-off.
They would use this calculation part of that.
Effectively, yeah.
And so what that's saying is that $50,000 over the life of 5 years is worth $26,000. Yeah.
Assuming a 14% discount rate.
Yeah.
And that's a big number. You would probably, in today's market, you would do something more like 5%. Okay, probably would be a more realistic number to use.
Yeah,
Because
so that was like the inflation rate. That's kind of the idea.
Right.
Okay.
Okay.
So if you wanted to do a credit for the tenant for build out on this example, and say it's $5,000, would you just subtract that from the present value?
Effectively,
And
yeah.
the payment?
Effectively, yes. Because the finish out's going to be done up front.
Right, so you do it, could we do that on this one?
Yeah, you're just simply saying that if you're basically having to pay a $5,000 finish out, then that means you're going to have left over $21,000 as far as your net.
And then you would just refigure what the, I guess the increase in the payment would be that you would have to charge them to get that same,
Correct.
okay.
Okay.
Why are landlords willing to do TIs?
Why?
Yeah, why?
Usually it's in the event that you have a sluggish market, okay? Everything depends on how strong or how weak the market is for, especially this goes for retail and for office, because those are the two property types that you're going to have the finish out allowances kind of factored in there. If you've got a situation of where there is a boatload of available space, you know, good quality space, whether it's, once again, office or retail, you as a property owner are going to do everything in your power to try to entice good quality tenants into your space, and you're going to be more likely to probably offer up tenant finish out allowances, even though it's hurting you a little bit, but it's better than having empty space. Mm-hmm. Whereas on the flip side, whenever space is tight, there's virtually no vacancy anywhere, and you know everyone is full, then you really don't have much of an incentive to offer that tenant finish out to the tenants. Now, you still may do so, you know, for certain tenants that you really, really, really want to attract, that's the only way they're going to come into your property. But, you know, for the most part, if the market is tight, there's really no direct incentive for you to have to offer that. Yep.
How would you structure the problem where if you're a tenant, and I mean if you're an investor, the owner of a piece of property, and you want to attract a tenant, and you have to do some sort of investment on the property. In other words, you have to build out for the
Right.
to calculate your maximum amount of investment on that property to attract that tenant. Like, I would say, okay, if he comes in for 5 years, you know, I could spend this much building out for him, or I could make that tenant stay 8 years if I invest that much. I mean, do you know what I'm saying?
Yeah. Part of what you're sort of suggesting is that, you know, is there a way to financially be able to model and to kind of say, all right, how much more money can I potentially get in rental income if I do a certain number of improvements to the property to retain that tenant? And that, you know, it's fairly straightforward in the sense that all you're really going to be doing is you're going to be looking at the incremental amount of additional revenue or net operating income that you can generate off of that tenant, and then apply
that to your initial investment.
Yeah,
You're gonna have
exactly.
to-
In other words, like, once again, as I said many times over, virtually everything comes back to ERV, you know, our very simple, you know, sort of investment model. And if you are able to generate an extra, by virtue of doing, you know, improvements to the property, you're able to generate an extra $5,000 a year of additional income off of that property, and your cost of borrowing, cost of capital is 5%, then what that means is technically you could spend an extra $100,000 up front in order to achieve that. Now, that's assuming that $5,000 is into perpetuity, meaning forever and ever and ever, okay? What you're asking is, well, what if they're gonna be signing like a 5-year lease, okay? Well, that's where we kind of come back to what we were effectively doing and just sort of saying, okay, we've got $5,000 a year of additional income. Our rate of return is 5%, or let's not do it that way. We just simply put it in as 5%, and we put in the term as a limited term of 5 years. How much more could we spend up front? So that limits the time from effectively forever and a day to just 5 years. And it works out to be $21,647.38. Okay, so what that's saying is, technically, if I did these improvements, whatever that you're wanting to do, and we've got a 5-year lease with a 5% interest rate, and we can get an extra $5,000 a year out of that tenant, then the present value of that, or the amount that technically we could spend today to do those improvements to be able to get the rate of return that we want, would be an extra $21,000. Now, why is this different than this? Because this is assuming it's only a 5-year lease. This is assuming this is occurring effectively forever. It's a continual perpetuity,
Right.
forever and a day. But as we increase the term here, this number is only going to get larger because, like, for example, and I'm going to get you in just a second. So let's say that we go to a 20-year lease, keeping everything else constant. We're up to 62,000. Okay.
It means I could spend today 62,000.
Right. If I get a 20.
If I get a 20 year, so that will.
Yeah, it makes a big difference. You know, and then we go on up to, let's say, 50 years, just for fun.
That's saying you can spend that in TI loans?
Yes.
Can you explain that to me?
If this is additional incremental revenue, this is not total revenue, this is saying we can raise the rent by $5,000 a year if I give them a tenant finish out of $21,000 up front. In other words, my cost of capital, we're assuming, is 5%.
So you're really saying that's the maximum?
That's the maximum.
Right, because that's
the
the
maximum that
capital.
we could give, and for me to be able to effectively break even.
Break even, right.
Okay, on the situation. So you're probably not going to give them that full amount. You're going to give them something. You're going to give them something less than that if you want to earn a profit on the deal.
Exactly.
And
Okay.
you're also saying that $5,000 is spread through. One
You're
payment.
paying. You're paying up front the $21,000, but the rental increase, yes, you're not receiving it until
The end of the period.
into the period for the next 5 years.
That's
So
a
basically-
one period per month though, right?
What? No, this is
I mean,
per
that's
year.
one-
Per
so
year.
If you did 12, it would take it to 5,000 per month.
Yes, which would be $60,000 a year. 5 times 12 is 60.
Is it spreading the 5,000 monthly though?
No, this is annual. This is annual,
So when do you get the 5,000? At the end?
at the end of December.
Okay.
But that's accounting purposes, I mean, you
Yes.
as a,
Right.
okay, yeah,
Right.
all right.
Here's what would happen. January 1st, you would write a check to the tenant or to the tenant's contractor for up to $21,000. For the purposes of accounting, you would not get that first $5,000 payment technically for accounting purposes until December 31st of that year. Yes, in the sense of you're going to get the check maybe right now in January, but the reality is for the purposes of the calculation, you really don't make the assumption that you receive it until December 31st.
But wouldn't they just normally just divide that between the 12 months of the payment and?
We could have done this monthly. There was no reason other than I just,
Okay.
for simplicity, just said, okay, let's just do it annual. It could have been done monthly, very easy.
Now, you,
Not to beat this to death, but can you go to the previous question for 1 second? Could you explain to me on there where your TI would come into play?
This one?
Yes. To his point, his question, Justin's question, you deduct it from the 26,000,
Correct.
okay, and
In
then
other words, this is the most that you could afford to spend on the TI as the
Okay.
property owner. Because if you spent all of this, you're getting no rent.
okay, gotcha.
Okay.
You're not earning any of that extra income.
Right.
If you spend all of that.
Right.
Right.
Period.
So you would just sort of like add a premium on top of, if it was 5%, add a premium on top of that if you wanted an extra 5% as your,
Right.
as your income, or your rate of return,
Right.
and then you'll see how much you can spend to get that rate of return.
Because on the margin, what we, in many instances, are trying to do, let's get away from these two examples here for a second. On the margin, what we are attempting to do as developers is create value. And to effectively take the market value that may be achieved for the average normal property within a market and put in elements that transform that property in a way that allows it to achieve a higher rental rate than the average normal property. What we have to be able to do, however, is to be able to say the extra dollars that we have to spend on the margin to get that extra rent, we have to make sure it's worth it. Okay? Because we can spend a lot of money making the building exceedingly attractive by virtue of design dollars going into that property in terms of extreme finishes to make it absolutely the most drop-dead gorgeous building it could be. But having spent that money, how much of that is going to translate into an extra increase in rental income?
Right.
And that's the part that we're sort of talking about this. It's very much, as I said, it goes back to that very basic, fundamental return that if we go from spending $100,000 to spending $200,000 on the building or on the finishes to the building, the base building is maybe $100,000, but we might go as high as $200,000 with all the extra finishes that we could put into that property, and our cost of borrowing is 10%, then that means in this first instance, we've got to generate $10,000 a year in net operating income. In the second instance, we've got to generate $20,000 of net operating income. Does that make sense to everybody?
Yeah.
And so what we're saying is that in essence, for every, whenever we increase the amount that we're spending up front on the finishes, on the final completed project, because of our cost of borrowing, cost of capital, that has to translate into a higher rent. Now, what happens if, okay, this is where I'm trying to make sure this is clear. What happens if we spent this extra $200,000, but our rental increase only allowed us to achieve 15,000 in net operating income. What that means is now our actual rate of return has not been met, or our cost of borrowing has not been met, and so it's, just make sure I do the math correctly, 15,000 divided by 200,000 would mean that now, for those three variables, we've dropped, our rate of return is now only 7.5%. So we would have been much better, from the development perspective, sticking with our original $100,000 building, earning our $10,000 a year, versus spending $200,000 and only increasing our rent to $15,000, which gives us a lower rate of return. Does that make sense?
Yeah. That's the
Now,
mistake.
in the perfect world, what happens is and this is the developer's dream, is that we spend this $200,000 and our rent goes up to $25,000, okay? Meaning now our rate of return is 12.5%. Okay, that is the developer's ideal, because we have spent extra money, but the reality of it is that's translating into then an overall increased value
Added value.
for the property. Does that make sense, everybody? That is fundamental. I mean, that truly is fundamental crux behind value creation. Because, like, the simplest example that you guys could relate to, like homes. A swimming pool in a home costs you a ton of money to put in.
Yeah.
But when you go to sell the property, it has virtually no impact whatsoever on the actual value of that home. In a lot of instances, can even have a negative value on the home, because anyone who's ever owned a home with a pool knows what it takes to maintain that pool and to keep it, active. Okay, so it's not usually a value creating kind of element on a typical home. Now, in some instances, yeah, you may have to have it in order to fit within a neighborhood or whatever, maybe a necessity, but a bigger value creator would be adding a second bedroom or a third bedroom or a fourth bedroom or an extra bathroom or whatever. That would generate, with the amount of investment that you do, more than likely is going to generate more value or more income from the property. Does that make sense?
Yeah.
In residential terms. Okay? On commercial terms, if you can create more leasable space within a property by converting space that was maybe potentially previously unusable or not available for some reason, like maybe you're able to now all of a sudden lease out your basement, or you're able to lease out your roof, or you're able to lease out some exterior space, then all of that is effectively value creation. Make sense? Okay. Questions? Okay. So that fully answer your question, Anthony?
It does, thank you.
Okay. Okay. Let's take a quick break. It is, looks like what, is it 9:30? Yeah. A quick 5-minute break, run around the hallway real quick, get some energy, come back, and we'll move forward.
Woo.
Try to do it on your own.
Just yesterday, I was working on a similar problem, but I didn't really take into account the value of money. We don't really borrow, so
Gotcha.
just do straight up.
Right.
Now, is that something you can do too, or you only?
Yeah, no, I mean, and that's the simplest of all, is just simply to say, look, okay, we're getting an extra, $5,000 a year for the next, 10 years, so that's $50,000 of total income, so we know we can spend something less than that.
But I think what I did was, I just gave them whatever the full 50,000 broke down to over 10 years.